income statement, which basically answers the following questions. How did the company perform throughout the period under consideration? And did it generate a profit or a loss? In short, it helps us understand whether the operations of the firm created economic value or not. By the same token, budgeting teams draft a projected income statement, which illustrates the company's expected performance in terms of profitability. We make the side note here that the terms profit, net income, and earnings are used interchangeably throughout the course. Okay. In reality, the income statement adopts various names, such as the statement of operations, the statement of earnings, the profit and loss statement, or simply the P&L. Whatever the title, it all comes down to the very same thing: a company's profit or net income generated as a result of the normal business operations. Simple as that. Before we begin, you must bring to mind that the two primary drivers of net income are revenue and expenses. It does ring a bell, doesn't it? Great. Logically, revenue minus expenses gives us the net income figure for the period. When preparing a budget, we have to start from the P&L's top line, the revenue figure. By definition, this is the inflow of economic benefits as a result of selling goods and services in the normal course of business operations. In budgeting terms, total revenue is based on the sales that a company expects to generate in the upcoming periods. We all know that revenue is the main profit driver. Without any sales, there would be no point in budgeting the rest of the P&L lines. Having a revenue estimate allows us to project the related production costs and other expenses and calculate how the company's profit will look like. All right, they say you must spend money to make money. This is why an income statement summarizes all the company's expenses too. Practically, this is the outflow of economic resources that results from normal business operations. To produce, deliver, and sell goods to clients, firms need to incur certain expenses. And so the most common ones are cost of goods sold, marketing, selling, general and administrative costs, also known as SG&A, depreciation and amortization, as well as interest expenses and taxes. Let's see what these refer to. Costs of goods sold are expenses that are necessary to manufacture the goods that the firm sells. For example, a dairy company needs to buy raw milk from local producers, transport, process, and then package it before it can sell it to supermarkets. Thus, to produce cheese, the firm generates some product-specific costs. Remember, expenses that directly derive from the production of finished products are recorded as cost of goods sold, or COGS. Here comes the exciting part. The difference between the total revenue and cost of goods sold is called gross profit. This is what a company makes after deducting its costs of production. If we scroll further down the income statement of a random company, we will certainly come across some operating expenses as well. These are the ongoing costs incurred for running the business. For example, every organization generates some selling, general, and administrative expenses, often called SG&A. This is a large income statement category that comprises the costs of making sales, such as marketing and promotional expenses. Besides, we also add office-related operating expenses like payroll costs for the management team or the accounting personnel. Office rent and utility bills are often common examples of SG&A expenses. So, gross profit minus SG&A comes down to earnings before tax, amortization, and depreciation, or EBITDA amount. This is another level of profitability that we will need when preparing the projected financial statements of a company. All right, then we come across the depreciation and amortization line. Broadly, it reflects the using up of tangible and intangible assets. Depreciation refers to assets of physical nature such as property, plants, or machinery. With time, the plants that a company owns become older, and therefore their value goes down. To account for such reduction, its accountants book an annual depreciation expense, which further decreases its profitability multiples. Amortization, on the other hand, is what we use to refer to the wear and tear of intangible assets, such as goodwill, licenses, copyrights, and so on. Okay, what's next? If we deduct the depreciation and amortization expense from the EBITDA figure, we obtain the operating profit of the company. It is sometimes referred to as earnings before interest and taxes, or simply EBIT. As easy as that. Hang on a minute. Since we have earnings before interest and taxes, shouldn't we have earnings after interest and taxes too? That's true. Most companies incur finance costs, which they don't consider when calculating their operating profits. For instance, interest expense is the cost that an organization incurs for borrowing funds externally. Quite often, firms would receive bank loans and pay interest expenses for the amounts they owe. So, the next accounting equation we need to remember is EBIT minus interest expense results in earnings before tax, or this is how we obtain the EBT figure. And finally, we have taxes. As Albert Einstein once said, the hardest thing in the world to understand is income tax. He might have been right. The rules for measuring the amount of income tax generated by a firm vary widely among countries. However, we will not go into the specifics right now. What we need to know, though, is that every organization pays corporate taxes that are proportional to the amount of their pre-tax profits. Once all expenses are recorded, we arrive at the bottom line, called net income. This is the excess of revenues over total expenses. It is also known as the bottom line of the income statement. The net income figure is very important as it represents the profitability of a firm after accounting for all its costs.